Hello, this is Rochelle Agatha, and this is the lecture for managerial accounting related to capital investment decisions and the time value of money. The first objective is to talk about capital investments and capital budgeting. Capital budgeting is a very important topic, and a lot of accounting people don't really get involved in capital budgeting depending on the size of the company, so it's really important that you understand it. Capital budgeting includes acquisition of assets used for a long period of time and which require large sums of money. There are four popular methods for capital budgeting: payback, accounting rate of return, net present value, and internal rate of return. And once again, there's a lot of topics in this chapter, and making flashcards might be a good idea. The cash basis versus accrual basis. Accrual basis is what's required by GAAP. Capital budgeting focuses mostly on cash flows. Only the AR method uses the accrual-based accounting income. Cash flows include future cash revenue, any future savings and ongoing cash operating costs, and any future residual value of assets. Capital budgeting process includes identifying potential investments, projecting the net cash inflows, analyzing the investments, and capital rationing. And when you think about capital budgeting, you really need a 5-year plan or more. It's not something you can look at a year at a time, because a lot of capital projects take many years to start, to plan, to get quotes, to get plans, and then you start them and they take a few years to do, and then they complete. So capital budgeting is a longer term activity. And then there's also post-audit implications. Sustainability in capital investments. In 2010, there was $243 billion invested in clean energy. You have to consider the payback period and the cost savings in tax breaks, grants, and lower operating costs. Objective 2 is using the payback and accounting rate of return methods. The payback period is the length of time it takes to recover the cost of the investment. The amount invested divided by the expected annual net cash flows is the equation. Here's an example. This firm is considering $240,000 hardware software investment. The company expects to save $60,000 each year for 6 years. So the amount invested divided by the expected annual net cash inflows. There's your 240 divided by your 60 is 4 years. The examples they give you, the equations are very, very simple. It's really in real life. How do you know where the numbers come from, and who decided that you were going to save $60,000? That's where the true analysis comes from as you move on in managerial accounting and learning that type of part of the problem. E12-17A, we're going to use the amount invested divided by the expected annual net cash flows. So if you look at the problem, same kind of a equation. Here's Exhibit 12-3, where it shows the years and the amount invested and the annual. And doing problems like this in Excel is really fast, because then you can actually build the formulas and watch them flow through. So at this point, you had met your capital investment before you got to year 4. So here we talk about after 3 years you'd receive 230, so you had a total left of 240, so you had 10,000 left, so you'll be receiving 50,000 in year 4. So it kind of shows you the wording of how you got where you got. So it's a 3.2 year payback. Now let's do 12-18A, same thing. Look at the problem and see how you lay out the cash flows and the cumulative net cash inflow. So here's your annual and here's your accumulative. So after 5 years, you'd received $1.3 million. So you had total left of 1.5 minus 1.3. You had 140,000 left to capture. So you'd be receiving $250 in year 6. So the payback period would be 5 years, and then a little stub of 0.56. The criticism of the payback method is the time value of money is ignored, and it considers only those cash flows that occurred during the payback period. The payback period decision rule is investments with shorter payback periods are more desirable, all else being equal. The accounting rate of return measures the average annual rate of return over the asset's life, so it's looking at the whole asset. Focuses on the operating income, not the net cash inflow. So here's your formula: the average annual operating income from the asset divided by the initial investment, or the average annual net cash flows minus the annual depreciation is divided by the initial investment. Here's an example. You have your $240,000 minus no residual value divided by 6 years is 40,000 of annual depreciation. So then you have your AR formula. So if you had 60,000 of cash flow minus 40,000 of depreciation divided by 240 is an 8.33 ARR. If the ARR is unequal to the net cash inflows, here's an example. You compute the average annual cash flows. So you take your 360 divided by your 6 periods, and then you compute your annual depreciation expense, and then you compute your ARR. So you get 10.42%. The decision rule is you invest in capital assets. If the expected accounting rate of return exceeds the required rate of return, you invest. If it doesn't, you don't invest. So let's look at 12-19A. So here's your year 1, your year 2, and your years 3 through 10. Total net cash flows less your total depreciation is your operating income over life divided by those 10 years is an average annual operating income of $111,000. So the average annual operating income divided by the initial investment is 7.4%. Let's talk about objective 3, using the time value of money. Time value of money, invested money earns income over time, theoretically. Cash received sooner preferred over being received later. You must look at the principal amount, single lump sum, annuity, and the number of periods, or you actually might have both, number of periods and interest rate. Here's Exhibit 12-6. So it shows you in your calculation, you take that 10,000 times 6% over the life, and that's your total interest. So simple interest is you only get interest calculated on principal. Compound interest means you get interest on top of interest, which is how most things work. Your present value and your future value, you have your time period. So in the future, you have a value, and the present value right now is 10,000. So your present value plus your interest earned is your future value. Which table should you use? Well, back in the dark ages, all there were tables, but nowadays everybody has these little apps on their phone and you hardly need tables, but it's good to understand how to use them. A single payment table is table A in your book, and a present value of an annuity is table B. Annuity means there's 2 or more payments. Which table should I use? Example 1, you will be getting $200,000 5 years from now. Interest rate you could earn is 6%. That is a table A. So you go to table A and you take present value of 1. You look for the rate and the years and you see the 0.747, and you take that times your 200,000 and you figure out 149,400. If you know how to do this in Excel, there's several formulas in Excel. It's the PMT or the rate formula or the future value formula. There's a lot of them, and it's really quick in Excel. Example 2, you'll be getting $1,000 for each of the 5 years. Interest rate, you could earn 4%. Table B, because you're getting more than one payment, present value of annuity, look for the 4% over 5 years. There's your factor, and that becomes your 4,452. Table versus calculator. You can do either. The calculator is more precise, and my accounting lab is set up for you to do either. So let's look at 12-23A. What to invest now to earn 8%. Present value of an annuity equals the payment times the table factor. So you take your 40,000 times 3.993 and you get 159,720. Requirement 2, what to invest if only earn 6%. You take your present value of an annuity equals your payment times your table factor, and there's your 40,000 times your 4.212. So make sure you can find these in the table before you move on to your My Accounting Lab, or do them in your own calculator so that you can do this without needing to struggle too much with your homework. Now let's look at 12-24A. Option 1, you have 14,500 for 5 years from now. Present value of 1 is 14,500 times the factor of 0.681. Option 2 is 2,050 at the end of each year for 5 years. There's your present value times your factor. So if you don't have a financial calculator, just use the tables in your book. Option 3 is 13,000 3 years from now. So you take your 13,000 times your factor of 0.794. So once again, make sure you can find all the factors in the charts. I'm showing you these so that the homework becomes easy for you. Objective 4 is use discounted cash flow models. A discounted cash flow model recognizes the time value of money. There's two methods, net present value and internal rate of return. The net present value is a discount rate, a hurdle rate, or required rate of return, required minimum rate of return given riskiness of your business or your investment. Proposal is acceptable when the net present value is greater than or equal to 0. Here's a net present value example. You have your annuity present value factor, I, there's your I is your interest rate, 14%, and your periods, N, are 5. That's how we write these problems. So you look for your factor on your chart, and here's your net cash inflow, and you times them and you get your present value, less your investment, so you have a positive investment. Decision rule is the NPV positive, then invest. If not, don't. And this is very textbook. It's not this straightforward in real life. There are times when a net present value comes above 0 and a company will still look at it and say, you know what, there's other risky factors involved and we're not going to do it. E12-26A, here's your project A, costs $272, offers an 8 annual net cash inflow, and similar salon products requires an annual rate of return of 14%. So you put your cash flow in for years 1 through 8. It's an annuity. Find your present value factor on the chart, multiply it through, there's your 280, and you get a net present value of $37,952. In Project B, the costs are $380 and offers a 9 annual net cash inflows. Salon Products demands a 12% on its investment, so this one failed. Net present value for unequal cash flows. When they're unequal, you must use the present value applied to each annual cash flow. So this is where Excel really helps too, to do these problems in Excel. So you're going to take your factor for each different cash flow year and amount and multiply them out to get your present value. And a long time ago, this was really difficult because doing it by hand takes some time, but it's very simple to set this up in Excel. So look at 12-28A. And I'm going to flick through them so that you can see it and follow through in your book. Let me get through to the bottom so you can kind of see the whole thing. So you have to do each year separately. So you're going to take your cash flows, the year, it's the lump sum, and go find the present value factor and multiply it through for the years so that you can add them up at the bottom. So your net present value at the end is $11,224 in the minus. So your investment is not covered by your cash flows. What's a profitability index? It's useful to compare projects of different sizes. It is the number of dollars returned for every dollar invested. So here's an example of Project A, Project B, and you have your present value of your cash inflows and your investment, and there's your profitability index. So doing 12-30A, your present value of your cash inflows divided by your investment gives you your percent for A and for B. So once again, make sure you can work these before you start your homework. And then your internal rate of return is your rate of return a company can expect to earn by investing in a project. The interest rate that will cause the present value to equal 0. And the overview is you find the discount rate that makes the cost of the investment equal to the present value of the investment's net cash inflow. So that's your internal rate of return. The annuity PV factor equals the investment divided by the annual net cash inflows. If the present value of an annuity table can, in the table, you can scan the row corresponding to the expected life and find the column with the factor closest to the annuity factor calculated. Trial and error process. IRR with unequal periodic cash flows. You can do a trial and error process. So the decision rule is invest in capital assets. Does the IRR exceed the required rate of return? Invest. If it doesn't, don't invest. So let's do one in 12-27A. Project A costs $280 and offers 8 annual net cash inflows of $64. You need 12%. Project A, the present value of annuity, $280 divided by the 64 is 4.35. The IRR is between 14 and 16%, if you go back to the chart and look that up. Project B costs $385 and offers 9 annual net cash inflows. You need 14%. So the project B, 385 divided by 74 is 5.203. The IRR is between 12 and 14%. Objective 5 is to compare and contrast the 4 capital budgeting methods. Comparison of the payback period. The advantage is it's simple, highlights risk. Disadvantages ignores cash flow after the payback period, and it ignores time value of money. The accounting rate of return is the only method that uses accrual accounting. It shows how investment will affect operating income, measures profitability over the entire life of the asset. It ignores the time value of money also. The net present value advantages are it incorporates time value of money and cash flows, indicates if the asset will earn minimum required rate of return. It's difficult to compare investments of different sizes. However, profitability index can be computed for capital rationing decisions. And then the internal rate of return, it incorporates time value of money, computes unique rate of return, no additional steps needed. It assumes that all cash inflows are reinvested at a rate equal to the IRR. So that's kind of that's a big disadvantage. And that's the end of the chapter. If you have any questions, send me an email. Thank you.